come on stage. Nicole, can you see?
Thank you.
Jimmy. And I think we're dialing in Jason Myers from Audit Chain. Jason.
Can you guys hear me?
Us? Can you hear us?
I can hear you. Can you hear me?
How are you feeling with your COVID-ness?
Fantastic. It's great. I love it.
Good.
Everybody should get COVID.
I think you should too. Anyway, good afternoon, guys. Welcome. Thank you very much for being here. I'm really lucky because I know that one on the screen. I know this one in the middle, and I've just got to meet. I've just got to meet Nicole. But let's start with you, Jason. Can you introduce yourself, please, to the audience?
Sure. My name's Jason Myers. I'm the inventor and lead architect for Audit Chain, which is an accounting, audit, financial reporting, and analysis virtual machine.
So we've got to get a lot of space on the stage because your face is really huge. Jimmy, possibly one of the best speakers I've ever had the privilege to listen to or work with. I'd love to hear your introduction, please.
Sure. A lot of you got to meet me yesterday. I'll keep it brief. As you know, I'm president of the global organization that supports the Bitcoin BSV blockchain, which is using the original Bitcoin protocol to scale big, as Satoshi always envisioned, to handle huge amounts of data and payment transactions and lots of tokenizing of assets.
Which is kind of germane to the conversation we're about to have. Nicole.
Hello. I'm delighted again to be here. I was actually a speaker on a panel on decentralized finance yesterday and earlier on NFT and intellectual property, and really happy to be here with you guys today. So my background is legal. I'm a traditional finance lawyer, securitization, structured finance. I work at Standard Chartered Bank, and in my, clearly my background has been working both in-house and in as well as in private practice. I'm also a film producer, and with a particular interest in futurism and also the future of banking, which is, I guess, what
I suppose also germane to the conversation. I mean, the title of our talk is a bit sort of wide scoped. So let's sort of bring it to a focus, which is how tokenization is going to affect banking and wealth asset management going forward. I think, Jason, considering you're so well versed in the topic of audit and all the rest of it, I think you should have a first crack at this and give us your honest opinion of how things are going to go.
So they're going now. As you can see that, banks are getting more and more involved in digital assets. It's a complete replumb, if you will. Right now, traditional assets are originated on paper or Excel, and they're kept on computers, and they're shared with other counterparties. You have DTC, who is a part of the gatekeeper structure. You have investment banks, broker-dealers. They are also part of the gatekeeper structure. You've got transfer agents who are third parties licensed to keep the records of share ownership. You've got lawyers and accountants who also play the gatekeeper role. And most of this stuff will be digitized from the standpoint of its ease of transferability, the ability to mechanize the prohibition of transfer pursuant to securities laws, the ability to keep record ownership. Right now, there is a slight snafu at a transfer agent in that SEC wants the transfer agent to keep records the same way they've always kept records. Whatever you do in addition to that does not alleviate your obligation to keep records the way they want you to. But, the one thing that nobody talks about is that if you're going to flicker on a ticker, you must provide financial disclosure. When I say you, I mean the issuer of the thing that flickers on a ticker, right? And nobody talks about it. The SEC doesn't give any guidance. They want you to hire a competent attorney. The attorneys don't really tell you. But the fact is, when you file an S1, you include 2 years worth of audited financial statements. And that is your coming out party. Your S1 is your coming out, right? And then your staying out is your continuous ongoing disclosure. And these are the conditions that are needed in order for whether you're digital or not, it doesn't matter.
Okay, Jason, sorry to cut across. We've only got 9 minutes left on this thing, so it's a short panel. I mean, the reason I went with you first is because obviously you're railing against the machine of the Big Four and the audit and all the rest of it, but I think that's germane to the whole scope of everything that we discuss in this field, in as much as, obviously, going back to your Satoshi vision, I mean, the whole thing was brought about by a reaction against the financial crisis in 2008. And I think from my point of view, I definitely had a personal interest in how does the man in the street access the deals that were normally the preserve of hedge funds, family offices, and pension funds, etc., etc. And when I launched Crypto.am back in 2018, the journey that we've been going through definitely has always been focused to a greater extent on institutional adoption. And my understanding has always been really that, A, they got pissed off because they didn't get it on the first run, and therefore they did everything they could to smash it so they could buy it cheaper. That could be a bit controversial, I don't know, but I think it's probably true. The other thing is that they aren't allowed to invest client funds into these sorts of things until the regulatory framework is there. So, with that in mind, we've seen a huge swing towards institutional adoption. I think and there's a huge increase in actors now in the space that makes it probably more. I mean, we always talked about the 4-year cycles, and there's, whether impending crashes are going to come, the volatility, but things are very different now than they were, when I started in this space and when other people entered. What do you guys how do you feel about where we're going and what the consequences are?
So I'm basically, as you know, I work for a financial institution. And as you said, at the beginning, clearly there was a lot of skepticism where this movement started. And I mean, a lot of people were trying to dismiss it, saying that it's not going to survive. However, I do think now that there is an overall understanding that it needs to be embraced. I mean, as we know, there are certain banks that already have their own blockchain proprietary technology. I think that we are also within my institution really embracing this movement. We're trying to see how we can synergize with the decentralized movement. We have set up a crypto custody business as well in London, and there are definitely very let's say there are initiatives that are designed to move more and more towards a digitalized service for clients and adopting blockchain technology across different spheres. We're still, of course, not there. Also, in terms of smart contracts, there's a lot of discussions. Also on the derivative space, there is an ISDA, the International Swap and Derivative Association working group that are developing smart contracts in the context of derivatives. But realistically speaking, we're talking about maybe 1 or 2 years before we can actually implement them and see them adopted, in actual, derivative space within financial institutions. So, right. So we're moving forward. There's still work to do. The point I wish to make is that we are definitely moving towards a highly digitalized financial sector.
Do you believe that there's actually the time to wait, in as much as when I first was told about blockchain, I was warned 10 years. Sorry, it was like 10x. The traditional wording of speed and time. But we don't even have time to talk about most of this stuff. I mean, is it really only 5 minutes left on this? Okay, fine. Right, so we don't have much time, so we can't even go to the metaverse, which I think is times 20x. Jimmy, let's have some words from you, because we've got 4 minutes and 55 seconds.
I can do it. Here's my perspective on this. This panel is about what wealth management and banking will look like in the future of asset tokenization. Remember, a blockchain is simply a new way to record data transactions, including of payments and other assets, in chronological order across time that's distributed and publicly verifiable. For banks, I talk to them and I give them this message. Banking and Bitcoin and blockchain can coexist. I don't believe Bitcoin and blockchain technology is designed to break down banks. The smart banks will adopt it. They can do so in 4 ways that lead to asset tokenization and which will influence wealth management for both high net worths as well as the retail man on the street. 1, custody, which you mentioned. I think banks are a perfect institution to provide custody of digital assets, which will increase in diversity. Safe choice for banks to do. They're already licensed to do it in most countries. Second, they provide trading services. More banks are launching trading platforms as an affiliate. We've seen this at a number of banks, for example, in Europe. So they can provide trading services to their clients for the assets they custody. So they're in a unique position to do that. Third, they can deliver new classes of financial products on those digital assets, such as staking and lending, creating peer-to-peer micro-lending, as well as a whole variety of other types of financial products that they'll know more because they're more traditional, but it'll just be based on digital assets. And then fourth, the main thing I think banks can be involved with is the tokenizing of real-world assets. And by that, I don't mean creating toy tokens like we saw during the ICO craze of 2017. Instead, I'm talking about using a big ledger, such as BSV, where you can do it very efficiently for low cost, to tokenize commodities, oil, gold, wheat, futures contracts, financial instruments. At our CoinGeek conference in New York a couple of weeks ago for BSV, a company in the US announced the first debt instrument to be tokenized and a fund to be tokenized on BSV. We'll see more of that, and then you can fractionalize a lot of these interests. Where banks can play is not necessarily handling that all, but they can either provide the custody, which holds the assets tokenized and allows the trading of it without moving the assets out of custody, which creates another inefficiency, creating a whole new liquidity pools for assets that would not normally have the same type of liquidity, especially if you have a very efficient ledger, not like Ethereum, which can cost $10 or $80 to send those transactions. That's why a scaled ledger like BSV or one of the other ones with massive scale and low fees gives you a lot more options to tokenize everything from gold and wheat and oil and the futures contracts, or you as an NFT. And that allows banks, traditional customers, whether they be high net worth, institutional, retail, to have access to more options for trading and wealth management.
Which brings me to oversight and back to Jason in a sense, because obviously, your mission is to sort of bring clarity to the sort of the audit area of life, and obviously everything that Jimmy and Nicole and I have been talking about. If banks, legacy banks, are going to adopt all of these technologies and all the rest of it, sure as hell, I suspect you'd want to make sure that there's oversight on how they, account for themselves. So I'm going to give you the last word, Jason, either.
Oh, it's not just audit. Audit is...
I saw him.
Hello?
We can hear you.
It's not just audit. It's disclosure as well, right? An audit is, and I'm not going to go into the nature and technicality of an audit because it's boring and it's probably unnecessary for this conversation. But disclosure is really important. When you deal with financial assets that are securities, oversight of the banks that create and trade them are covered by the 34 Act in the United States, and to the extent of the rest of the world, there are very similar frameworks. The initial issuance of the asset is covered under the 33 Act in the United States and very similar frameworks outside the United States. But all of which, 70% of which, in terms of the issuer's responsibilities, has to do with disclosure, right? And, we always come back to this, but nonetheless, we have a very fast-moving industry that is really, it's dominated by, when you really think of it, we're a bunch of crazies. And that's why we go fast. Because if you look at platforms like Uniswap and Compound, Aave, the banks will never catch up to that. And if they do, when they do, these types of platforms will become something else, right?
Jason, I'm so sorry. I'm going to have to get one last word to wrap it up on that one.
Yeah, I mean, who would have ever thought that, you'd be able to make 50,000 markets with 11 employees? I mean, that's just
I completely agree that it's almost impossible for people to keep up. I mean, the pace of change is so ridiculously fast. Legislators, whether they're political or fiscal, a kid's got to come up with something cool, something new. I mean, I often talk about a friend of mine called Stanny who had 40,000 staked when he had something called ETH Land, and now Aave has 23 billion staked within a very, very short space of time. I mean, it's the speed at which these things happen is astonishing. And echoing Jimmy's talk about time, we're well and truly out of time. But guys, would you like to say one last little comment before we wrap up?
Last thing I'll say is, we have to get out of the mindset that banks and Bitcoin and blockchain don't go together. I talk to a lot of banks and I encourage them to think, how can they deliver their traditional class of banking services, whether it be deposit, interest, payment, loans, settlement of payments across boundaries, using a blockchain ledger for more efficiency. It's totally possible. Companies are building products on it, and that's why I think the worlds will all converge.
And I also wish to add that I completely agree with you, but I think that banks understand, the management of banks do understand that in order for them to stay competitive, they need to transform, and they have transformed in the past, and they will transform again. And this is happening now as we speak. Of course, as you were saying, the process of change is very, very fast, and it's very important now not to lose momentum, but it's certainly not mutually exclusive. We can certainly collaborate and work together to improve technology and give greater accessibility to the world and make it a more efficient financial system.
Completely agree. There's a middle ground, a hybrid solution where both sides can cooperate without sort of almost ensuring mutually assured destruction. So on that tender note, why don't we finish and say thank you very much to everyone. Thank you.
Thank you indeed.
Thanks, everyone.